Tax loss harvesting is an investment strategy that investors use to maximize their returns while minimizing their tax liabilities. But is it right for everyone? And what do you need to be aware of? That's what we're getting into in today's video. Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in this video, we're breaking down tax loss harvesting basics and the rules and regulations that you need to know before you sell investments at a loss. So, Brian, let's start with just a quick definition of tax loss harvesting, which, by the way, that is a mouthful.
It is. It is. Actually, in the simplest terms, tax loss harvesting is the timely selling of securities at a loss to offset the amount of capital gains tax owed from selling profitable assets.
Okay.
Basically, it involves selling an asset or security that has declined in value at a net loss. Realizing a loss allows investors to reduce their taxable income and potentially lower their overall tax liability. So, for example, a loss in the value of security A could be sold to offset the increase in the price of security B, thus eliminating the capital gains tax liability of security B.
Okay.
Losses on your investments are first used to offset capital gains of the same type. Therefore, short-term losses are first used to offset short-term capital gains tax, and long-term losses are first used to offset long-term capital gains tax. They got to be kind of equal, okay?
Sure.
Same type.
Sure.
These losses can be used to offset taxable gains in the same tax year or even carried forward, Michelle, into future years.
Okay.
One last thing. This is normally a year-end strategy, but it
Mhm.
can be used during periods of high volatility as well throughout the year.
Obviously, a benefit of this is minimizing taxes because then you can offset capital gains from other investments that have appreciated in value, and capital losses can help reduce or eliminate your tax burden. What other benefits are there to this strategy?
It may help increase your portfolio value. When
Okay.
you are strategic about your losses, it may enhance your after-tax returns, which helps with the growth of your portfolio.
Okay.
Tax loss harvesting also provides opportunities to rebalance your portfolio and invest in alternative assets within the same asset class or sector.
How much tax loss harvesting can you use in a 12-month period?
Yeah, according to the IRS, if your capital losses exceed your capital gains, the amount of the excess loss that you can claim to lower your income is the lesser of $3,000,
Okay.
$1,500 if married filing separately,
Huh.
of your total net loss shown on line 16 of Schedule D of the Form 1040. If your net capital loss is more than this limit, you can carry over that loss forward to later years. And Michelle, that's indefinitely.
Okay, so that's interesting. So an individual taxpayer can write up to 3,000 in net losses annually.
Yep. And there's no
Okay.
limit on that amount either. It's $3,000. And it's funny, Michelle, over the years as an advisor, if I look at a client's tax return, I could tell how big their losses were if I can see 90,000 or 120,000 written there in losses. They need at 120,000, that's 40 years of losses that
Sure.
they can write off.
Okay. All right. What do investors need to be aware of before they attempt this strategy?
As with most financial strategies, there's some gotchas you got to watch out for.
Always the gotchas.
Always the gotchas. The first one is the wash sell rule, which prohibits you buying the same or identical investment within 30 days of realizing that loss. Okay. Failure to comply with this rule will instantly nullify that tax benefit.
And that's the wash sale rule, right? That's what
That's
you
the
said?
wash sell rule.
Okay.
So you can't sell your Tesla at a loss and buy it back within the next 30 days, or it eliminates the loss that you just applied for.
Okay. Understand.
The second is long-term capital gains taxes. You need to evaluate the tax implications of selling your long-term holdings, as you may face higher tax rates compared to short-term capital gains.
Who is this strategy right for? And did you need the input of, let's say, a tax professional or a financial advisor or both before you do anything?
I'll answer that last part first. Definitely consult with a financial advisor or tax professional for implementing this strategy effectively. It's
Okay.
that simple.
Okay.
As far as who's this right for, it's not for everyone. Okay. If you're a high income, long-term investable with taxable accounts, that means not IRAs,
Sure.
and they have capital gains, tax loss harvesting may make sense. If you have qualified accounts, IRAs, your 401ks, or you're a short term trader, or you have low income, tax loss harvesting won't be of a benefit to you.
Makes sense. Okay.
Also, it takes careful planning and a clear understanding of the IRS rules and regulations. If you aren't willing to do the homework or you don't seek an advisor that understands these rules, tax loss harvesting won't even make sense for you.
Okay. Well, that about wraps us up. We're going to drop a link to a video we did recently on the 1099K tax form that most Americans are going to get for their 2023 taxes. It's coming like a freight
Yeah,
train.
it
So
is.
go check that out. Really understand what the tax implications are going to be so you can prepare now. Also, if you like the content of this video, hit that like button. Don't forget to subscribe. All right, Brian, thanks so much for this. And thanks to everyone who watched.
Thanks, everyone. Have a great day.